The insurance revolution. In this episode, I'm going to address the question, why is IUL income tax free? I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 48 years, nearly 5 decades. What have I been doing for people? Helping them optimize their financial assets, minimize taxes, and empower what I call their authentic wealth. Usually for long-term goals like retirement, people have come to me for at-retirement planning, which is something totally different than for retirement planning. And usually I'm having to help them reposition their assets into vehicles that will be tax-free during retirement, because most retirees are in danger of outliving their money due to the negative impact of taxes, eroding away or taking away at least a third of their income if they have $1 million nest egg. And if it's earning 7.5%, and they don't want to deplete their principal, they pull out $75,000, but they only net $50,000 to buy gas, groceries, prescriptions, golf green fees, or whatever, because they have to pay tax. And maybe they can't get by on $50,000 because of the second danger, inflation. Inflation at the recording of this episode last year was 15%, was the actual rate of inflation, which means the cost of living will double in 4.8 years. So retirees in particular, this is like a hidden tax, because if you could get by on $50,000 today, in less than 5 years at 15% inflation, you're going to need $100,000 to buy the same gallons of gas and loaves of bread that $50,000 buys today. And in less than 10 years, you're going to need to have $200,000 to buy what $50,000 buys today. So the second big danger is inflation. The third is market volatility, because usually when we have irresponsible government spending and the printing of money that causes us to incur higher taxes and inflation because they're printing money, we also have market volatility. So that's why my favorite vehicle in the Internal Revenue Code, I call it the Laser Fund. Laser is an acronym that stands for Liquid Assets, Safely Earning Returns, is a max-funded tax advantage insurance contract, indexed universal life, structured correctly and funded properly. Then it is qualified to be what I call a laser fund, okay? Now, laser is an acronym that stands for Liquid Asset Safely Earning Returns. So when people ask me, okay, Doug, I'm getting it, but tell me, why is IUL, Indexed Universal Life, income tax free? I mean, as soon as the IRS finds out about this, they're going to close that loophole, right? And I sort of snicker and I go, no, it's not a loophole. The IRS knows all about it, and they're the ones who actually have dictated the parameters on why it's tax-free and how to keep it tax-free. And so far, it's been a sacred tax-free cash cow in the Internal Revenue Code now for over 108 years, and I'll explain reasons why, okay? And so this really was an insurance revolution that was started not by an insurance company, but by a brokerage firm, E.F. Hutton. You may have watched other episodes on this channel where I talk about the history behind the emergence of universal life and then indexed universal life. So I started in 1974, and I went out, and from 1974 to 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And I was a big proponent of buy term insurance and invest the difference, because I felt like, well, you could put your money in the market and maybe you could earn an average of 9 to 12% before tax, which would outperform most whole life policies that unfortunately only usually performed at maybe 2.5%, 3.5%. Even if they credited you 8 gross with dividends, you might only net 5 or 6%, even by the time you were 90 years old. So I thought, I can outdo that, even though those are tax advantaged. Well, E.F. Hutton was really the brainchild behind the emergence of universal life. It wasn't whole life, which is basically built on a chassis designed for death benefit, first and foremost. You can use it for living benefits, but to create predictable cash flow or income, during retirement, you're hard-pressed to see a whole life policy actually perform to create predictable income. Okay. Now, they said, hey, let's see if we can take the least amount of insurance on a policy that the IRS will let us get away with, and let's put in the most premium or the most money the IRS will allow as fast as the IRS allows. And let's use life insurance for living benefits because it will accumulate money tax-free. So it wasn't whole life, it wasn't term, and so they called it universal life because it was universally applicable, where you could minimum fund it for less premium than whole life for permanent insurance because of those high interest rates back in the 1980s, where I got credited between 11.75% and 15.5%, never less than 11% from 1980 to 1990. And so I had clients putting in big lump sums of $500,000, and they were earning 11, netting 10, pulling out $50,000 a year tax-free right off the bat. So what was E.F. Hutton really thinking? Well, this multi-trillion-dollar insurance industry is not only the backbone of America, but the backbone of the world. This is where governments go to for help when they need help. Some of these insurance companies manage as much money as the IRS collects in income tax in an entire year. And so what do? Well, money inside of a permanent life insurance policy now for over 108 years has been sort of a sacred tax-free cash cow because under Section 72E of the current code, money inside of an insurance policy grows tax-free, the interest, the dividends, and so forth. And if you want to access money while you're alive, you can do that if you do it the smart way under Section 7702. And so this insurance revolution that E.F. Hutton said, hey, nothing else does that. And then when you ultimately die, anything left in there when you die blossoms, increases in value, and transfers out tax-free in a death proceed, life insurance. That's under Section 101A. So Hutton said, there's nothing else in the Internal Revenue Code that does that. Municipal bonds don't do that. In other words, you can accumulate money tax-free, you can access it tax-free. When you die, it blossoms and transfers income tax-free. So they said, well, let's use it for living benefits. So let's take the least amount of insurance. And this is why people were putting in, $500,000 and taking out a dinky amount of life insurance. And the IRS said, what are you doing? And E.F. Hutton said, we're not doing anything wrong. They went to court. E.F. Hutton won. They weren't doing anything wrong. And you probably have watched other episodes on this channel, but if not, I'll just summarize here. The IRS went to Congress and said we have to change the definition of tax-free under these three sections of the code. If you violate the definition of tax-free insurance, it's going to be taxable under the investment part of the code. Investments are taxed sooner or later, and they're usually subject to volatility. So in 1982 and 1984, under the Tax Equity Fiscal Responsibility Act and the Deficit Reduction Act, we have these two acronyms called TEFRA and DEFRA that basically dictate the minimum amount of life insurance that has to be attached to the account, so to speak, so that it stays under the definition of tax-free insurance. But TEFRA and DEFRA gave parity so that it doesn't matter if you're 20-year-old, if you're 60 years old, or if you're 80 years old, the amount of insurance required goes down as you get older, and the more unhealthy you are, the less insurance you get away with. So that an 80-year-old can earn 11 and net 10, a 60-year-old can, and a 20-year-old can, because the 80-year-old gets away with less insurance than the 60-year-old, and the 60-year-old gets away with less insurance than the 20-year-old. Everybody can earn, let's say, 11 and net 10, or earn 8 and net 7, or some years earn 25 and net 24, because the cost of insurance stays the same no matter how old you are or how unhealthy. And if you're totally uninsurable, it's the owner of the insurance policy that gets all the tax-free accumulation. You can actually put the life insurance death benefit on a surrogate, a spouse, or your children, okay? So TEFRA and DEFRA have to do with the amount of insurance so that it stays tax-free. TAMRA happened in 1988 under the Technical and Miscellaneous Revenue Act. That spells the acronym TAMRA. And so this dictates, hey, do you want to access your money tax-free? And it was actually came about because of the banks and the brokerage firms in 1988 couldn't compete. They saw this massive exodus of money leaving their institutions into these. because these were safer. They paid higher interest. They were tax-free. They blossomed when you died. Their accounts didn't do that. But they didn't want to kill them because this is where they put 30 to 40% of their tier one assets for liquidity and safety. And so they wanted to slow the flow. So I've explained in episodes that, and in my various books, I compare it to a metaphor using a bucket. And so let's say a bucket is an index universal life insurance policy, and you're a 60-year-old male. Well, when you do what E.F. Hutton came up with under Tefra, Defra, and Tamra, a male age 60 who wants to put in $500,000 and have that $500,000, let's say, earn the best possible rate of return. I've averaged about 9.62% in 20-year periods. Let's round that down to 9.6. That means $500,000 will double every 7.5 years. What you're wanting is the least amount of insurance, because you could buy a ton of life insurance for $500,000. No, you want the least amount. At age 60, Tefra and Defra says that's maybe twice that, $1 million. It also means that when I put in $500,000, the amount of insurance the insurance company is charging me for, if I select the level death benefit option, is the difference between my money, which now is part of the death benefit, and the actual death benefit. So when I have $500,000, they're only at risk for the other $500,000. They're only going to charge me for that extra, that differential. When this doubles in 7.5 years to $1 million, now I'm self-insured. Now my money equals the death benefit. When that $1 million doubles to $2 million in another 7.5 years, the death benefit actually has to stay ahead by 5 percentage points. If I died in the 15th year from this example, it may leave behind $2,050,000. But I'm only being charged for $50,000 of life insurance because $2 million of it is my money. Does that make sense? So when you structure it correctly and fund it properly, the insurance gets cheaper as you get older. And so Tamra says, if you want to access money, if you threw in all $500,000 in one fell swoop, like we used to back in 1980, it will grow tax deferred. If you die, it will blossom and transfer income tax-free. But if you want to turn on tax-free income, you have to comply with Tamra, and you have to spread it out. So if you're over age 50, basically you have to fund it maybe about 20% a year. It's an exact number based on your age, but I'm just going to simplify it here. So the most you could put in would be $100,000 the first year, $100,000 the second, $100,000 the third, and then the fourth, and then the fifth year. So after 5 years, you've complied with Tamra, and now when you access money, as this doubles to $1 million, $1 million doubles to 2, 2 million doubles to 4, 4 million doubles to 8. Yeah, we have clients who now have $8 million, and it generates $600,000, $800,000 a year of tax-free income without depleting principal because they complied with Tamra when they funded it. Okay, so Tamra is really good if you want to turn on tax-free income. So that's the insurance revolution and why it has become one of the most incredible instruments that knocks the socks, in my opinion, off of IRAs and 401ks and even Roth IRAs or 401ks. I've never owned any of those. I never will, because Roths only have two benefits. Your money grows tax-free in a Roth. You fund it with after-tax dollars just like this. Roths only came out in 1997. Roths have too many strings attached. You can access money tax-free, but you can only put in a certain dollar amount or a certain percent of your income. I can structure one of these to hold $500,000, $300,000 a year, 5 years. I don't have to put in $300,000. I can put in $30,000. I can make up the other $270,000 anytime I want. In a Roth, you're limited to a certain percent of your income. You cannot touch it for 5 years until you're 59 and a half. With a Roth, you can't use indexing. With indexing, I can tell the insurance company to take the interest on my money and fund an options budget, and they will do that, and they will credit you whatever the S&P or the Dow does, and you can watch episodes on this channel about indexing. And so when the market goes up, I can get credited 8%, 12%, even 15 and 25 and 61%. Many clients have actually achieved that. But if we guess wrong and the market dives, crashes, you do not lose one dime of your money that you had at the beginning of the year. You just relinquish the interest on your money that year because your money is not at risk in the market. That's called indexing. And this is where people generally will earn more like 9 to 10% by employing indexing based on actual historical performance. So this is why it's called the insurance revolution. And this is why we compare it to a 5-story building. If the IRS said, hey, you build a 5-story building, if you'll just rent out the first floor the first year, the second floor the next year, and on to the 5th year, and if you just take 5 years to fill it up, the rental income forever after will be tax-free. Sounds silly, but I would do that. That is a max-funded insurance contract in compliance with TAMRA. So this is the beauty behind a max-funded insurance contract. Structured correctly and funded properly, it qualifies to pass the laser test. Liquidity, safety, rate of return, and tax benefits. That's why it's called a laser fund. Does that make sense? So this is the insurance revolution. I credit E.F. Hutton. They weren't an insurance company. They were a brokerage firm, but they knew it was far better to earn, let's say, 11 and net 10 than trying to earn 15 or 16% in a tax-deferred IRA or 401k in the market to net 10 after tax. So this is what I would like you to do. Take advantage and learn about this. This happens to be chapter 7 of this book called The Laser Fund, and I want to gift you a free copy. Here's how you can claim yours. You don't have to shell out $20 on Amazon. This is actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs. If you're more of a right brain learner, you flip it over and read this one. There's about 100 pages, 12 chapters with 62 actual client stories. But you go to laserfund.com and or click on the link below. And in laserfund.com, you contribute a nominal amount towards the shipping and handling. I cover the rest of that cost. I'll fire out a free copy to you, but there's also options there to listen and learn, watch and learn. Also check out some of the online educational webinars. They're free. And if you want, you can even talk to an IUL specialist that will help you understand how this may apply to your particular set of circumstances. But this is about you and your brighter future. I do not want you to outlive your money due to the negative impact of taxes, inflation, and market volatility. Make yourself immune, eliminate those dangers by employing a laser fund.